Hey everyone, welcome in to another daily editorial here on the KE Report. We are chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, there's not a whole lot to talk about price action-wise when it comes to the precious metals, so we're going to take a step back and look broadly at some economic data as well as some of the more fundamentals around the precious metals. Starting off with economic data, and the data that has mattered the most this year has been inflation data. Now, we do have some inflation data coming up, but overall, the last read that we got from inflation was a spike higher, over 6%. Now, that brought out a lot of the inflation bulls saying, look, inflation is here and it's going to continue to trend higher. The Fed very much wrong about their transitory comments. Now, the thing with the whole transitory argument is that's more or less open to interpretation in terms of how long the Fed will wait to maybe admit that inflation's hanging around longer than they want. But Jordan, what do you think about inflation moving forward here? Has inflation hit a recent peak? Do you think it moves higher from the most recent 6.2 reading? What's your take on it?
I think it has peaked. I mean, I'm not an economist, but I think if you want to get a sense of where things might be going, you have to watch the market and listen to the message of the market. And, we've seen a rebound in bonds from extreme oversold conditions. We know that going back to 2013, at the tail end of that year when the Fed started tapering, bonds had a really big rally. And, it makes sense. And the Fed is about to hike rates. And so we know that when that happens, usually bonds are going to, well, the curve is already flattening. But the reason that happens, at least temporarily, when inflation expectations are not raging, is because sometimes you can get a flight into U.S. government bond. You get a flight out of all the other lower quality stuff into the high quality. So I'm talking about bonds. I'm really talking about government bonds. But, moving over to commodities, just looking at a lot of commodity charts, I mean, I think a number of commodity stocks peaked in the first or second quarter this year. I mean, you look at copper and industrial metals. I mean, those price indices that I look at, I mean, they basically peaked, I think, in the spring. You look at those, they're at massive, 10-year resistance levels where they've had a huge move and they're not going to break through, in my opinion, at least not yet. And a pullback for a year or two is perfectly reasonable. Oil had this huge move lower, so energy prices are definitely a leading indicator. And I think looking at oil, I know that the recent peak was around 85 and it declined all the way to the low 60s. It's back to 72 now. It's had a good rally. The key is if oil does not make a new high, in the next quarter or two, that's telling you that inflation is likely to go lower. So that would be the canary in the coal mine as far as my forecast for lower inflation. If we see oil make a new high next year, that would perhaps tell us that inflation is not transitory. So we have these factors which are moving targets. But, circling back to the main view, I just look at, gold and silver. They were the first to peak. Gold's usually the leading indicator for commodities. It's been correcting for over a year. Copper and industrial metals, they peaked, I think, in the spring. Yeah, I mean, we've had, a huge move in uranium along with energy. But if the oil price doesn't get above 85 in the next couple of quarters, that's more evidence that inflation has peaked. And so look, for this call to be right, inflation that's at 6%, you said, Corey, if it goes down to 4% or 5% over the next 12 to 18 months, the call is still right that inflation has peaked. I mean, I'm not saying inflation is going to go to zero. I'm just saying it's peaked. The rate of inflation is going to go lower. And that's really the question for next year is how much lower it's going to go. Is inflation going to persist at 3 or 4% for a couple years, or is it going to go all the way back down to 2%? Those are the questions. But I think inflation has peaked for the next year.
Yeah, these discussions on inflation are always interesting because ultimately, inflation is just the increase in money supply. And with all the stimulus that was printed last year and all the helicopter money, that's what leads to inflation. And things like the consumer price index are simply the symptoms. The higher prices are what happens when you create the bigger money supply. So to the Fed's own admission, inflation has run hotter and run longer than they expected. And let's not forget that just last week, Jerome Powell admitted he's going to have to retire the word transitory. So that pretty much sums it up right there as far as was it transitory or not. The question is, what is the rate of change going to be? And as you outlined, Jordan, if this was a peak in inflation in October and we start seeing things taper down into next year, even if inflation stays higher than it has been for the last decade at, let's say, 5% or 4% or 3%, that's disinflationary, but it's not deflationary. And we're hearing all these terms in the marketplace like we could be ready for a deflation, or we're in the middle of a stagflation, or watch out for hyperinflation. So I'd love to get your thoughts on unpacking some of these terms, because sometimes it comes down to a semantics issue. But I'd also like to get your thoughts on how are the commodities going to be affected, because if prices are down because of a disinflationary period, and if we've already hit a peak, how will things like silver fare, which is generally tethered more to the commodity sector than, let's say, gold, which is more of a monetary metal? So it'd be great to get your macro thoughts on how this all fits together as we move forward towards the Fed rate hiking cycle the middle of next year.
Well, yeah, there's a lot to touch on there. I'll try and answer as much as I can. With respect to the terms, the one thing for people to think about is when inflation goes down, when it's the rate of change, as you speak of, when it's declining, that's disinflation. I mean, think about inflation being 1 or 2% for most of the last 10 years or whatever you want to look at. I mean, that, people say, oh, we've had deflation in the markets and the economy. That's not really true. I mean, we've had disinflation, which just means there's inflation, but the rate of change is not moving higher. I mean, that's what's bad with respect to the economy, is when the rate of change of inflation is moving higher. And I think from a very big picture, 10, 15-year view, that the rate of inflation is moving higher, but within that time period, the rate of inflation can move lower, and that's my expectation for next year. And there's a lot of ways you can track it with looking at the charts. Like you can look at tips against regular bonds, like that's an inflation indicator. You can look at the silver to gold ratio, I mean the gold silver ratio. But if you're looking at silver divided by gold, that's also an inflation indicator, because when silver outperforms gold, that can reflect rising inflation or rising inflation expectations. There's some other indicators you can look at. Industrial metals prices, the dollar is also one, for example. So, looking at those market-based indicators, I see a very, very low risk that the rate of inflation rather, is going to be higher next year. And with respect to silver, that's one reason why I've been concerned about it in recent weeks. And, it had that bullish bottoming pattern, and I wasn't, we spoke about that like a month ago. I wasn't quite sure it could hit the target. If my view is correct about a lower rate of inflation, that's going to be negative for commodities, but especially negative for silver. And so I am definitely concerned about silver. I think, looking at the long-term technicals, I see a lot of strong support around 1870. I mean, there is some support at 21, but I think 1870 is the potential downside that you're looking at. However, yesterday I did look at how silver performs after the Fed hikes rates, when it starts a new rate hike cycle. And looking at the last 4 times that happened, silver has an average gain of 42%. And it's interesting because we've talked about that catalyst for gold, but it's actually even a better catalyst for silver and the gold stocks. So right now we see silver and the gold stocks, they're struggling, they're lagging, they're underperforming as the sector corrects. That's really bad. However, the closer we get to the rate hike next year, now obviously all these things are moving targets, but the closer we get to that, the closer we're getting to a point when, gold, silver, and the gold stocks can have a really good rebound from that point. So I hope that touched on most of the things you asked.
Hey, that would be encouraging when, I guess, the rate hike happens, and if that does drive the precious metals higher. But right now, look, we do need to remember that inflation, all the data was stuck around 2% and below 2% for really over the last decade. And it was right after that COVID washout that we started to see inflation pick up. And it's been just this year that inflation truly did pick up. So let's see where it goes from here, and if there is a top around that 6.2%. Jordan, what about gold's fundamentals, though? We hear so much about these commentators say gold's fundamentals have never looked better for the longer term aspect. And when I hear that, I cringe a little bit, because to me, that's just too broad of a comment. People don't necessarily point to individual factors. And well, the one factor that I hear all about is look at all the money printing. All that money printing definitely has to lead gold higher. We've seen a lot of money printing, just not in the last 2 years, but over the past decade. And gold, it is higher generally, but it's not in the $5,000 region that some of these commentators are saying it should be. What are the fundamentals that you're looking at for gold?
Well, when they say long term like that, I agree if they're talking about 10 to 20 years, but not necessarily the next year. So they need to quantify that with a time specification.
But then they get stuck in a corner, right? Then they can't be right because, well, they put a time frame on it. That's what I get afraid of when they say long term.
Right. Now, with respect to fundamentals, I mean, the major driving factor is declining real interest rates. And so that's actually the key word, declining. I mean, we're talking about the rate of change. That's really what's important in assessing a lot of these things. And so, yes, negative real rates are good for gold, but declining real rates is really the key for gold. And they have to be, when I'm talking about declining, real rates need to be around zero or close to zero. If you look at the 80s and 90s, there were some periods where it was declining from like plus 7% to plus 4%. Like that's just too high. That doesn't really impact gold that much. But, you know, the issue for gold and real rates recently, and gold has underperformed real rates recently because real rates have continued to decline a little bit or remain really weak even after gold peaked. And my thinking behind why that has happened, I know a lot of people say manipulation, but my thinking is the market is discounting the fact that inflation has peaked. And so, and the Fed is going to hike. So, I mean, that's bad for gold because, you know, the real Fed funds rate is what, -6 or -5%, whatever it is. But the market has been looking out and seeing this is not going to go to -7 or -8%. It's going to go to -3 or -4%. So that's why gold has been weak. And it's similar to what happened 2011 to 2015, where I think, you know, the real Fed funds rate went from like -5 to -1%. Like it was negative the whole time, but it was getting less and less negative. And so that was bad for gold. And that's, you know, in a shorter period now. But that's been the issue right now, is the fact that real rates blew out on the downside. Like it was so good for gold that they got so negative. But the fact is, you know, the rate of change, like they can't get, they can't go to -6 or -7% from, you know, from where they are now. So that's kind of, you know, the issue over the next couple of quarters. And, you know, in addition to that, you know, you also have to look at technically how is gold performing in relation to the stock market. And I mean, we've seen this. If you look at, for the majority of the time, gold has performed really well historically. It's usually been around points where, you know, you've had a recession, a bear market, or the stock market has been really weak. I mean, I know there's the mid 2000s. That's like the one outlier. And then there's points in the mid 1960s. But I mean, aside from those times, most of the time, gold's best moves have come usually during a stock market decline or immediately after a stock market decline, because, you know, during or after a market decline, usually real rates are going to decline. You know, it's either happening then or the market is forecasting that it's about to happen. So that's, I mean, technically, that's the other thing that we have to watch, is how is gold performing relative to the stock market. And, you know, the stock market just, it's continued to move higher. And I mean, we've talked about that for months and months. You know, that's been negative for gold. So the fundamentals right now are not good for precious metals. And that's why technically they look like crap, to be honest. But, you know, that being said, I'm always looking ahead, and I've pointed out the potential for a Fed rate hike. I mean, yesterday there was a 39% chance of a hike in March and 60% in May. So the market is definitely, you know, these things are moving targets. I mean, assuming we don't have a big decline in the stock market over the next few months, we're probably going to get a rate hike sometime in the spring. And, you know, that's going to lead to a really good move in the sector for the second half of the year. But until we get to that point, you know, here and now, the technicals are negative. the fundamentals are negative and there's more downside. But, eventually, I mean, if I'm right about that and the sector moves lower, eventually prices get low enough where they've already discounted all this bad news. They get to really strong support levels. Sentiment then blows out on the downside. And then you look at some of these stocks and think, wow, these are really, really cheap. That then is the point to become bullish, but we're not quite there yet.
Well, Jordan, just looking forward at that rate hike cycle that most people believe will happen in the spring or summer, and knowing that historically this is good for the precious metals. Typically they sell down going into that, but then after the rate hikes start, they start ratcheting higher, just like we saw at the end of 2015. But that will also typically pressure the markets. The question is really going to be, do you think when they start these hikes, they're going to be 0.25 basis points, or 0.5% moves? Because that's not going to really do much to the real rates. And if inflation does come down and they hike it just a little bit, that's still compressing the real rate some. Could it be that the hiking the rates doesn't have the same effect it's had in previous cycles if the stock market doesn't sell off enough and if it's not a big enough rate hike to really move the needle?
I mean, it's a really interesting question because I'm wondering how this cycle is going to play out, because the last cycle, they went from hiking rates to cutting rates. It literally happened. Their last hike was in December 2018. Gold bottomed a couple months before that, and then they were cutting rates in June. So they telegraphed that to the market before June. So it was like they went from like their last rate hike to cutting rates in 5 months. So I'm not sure how long they're going to be able to hike rates. And I mean, that's where it's, I think, my template for next year, obviously, like I say, things are moving targets, things can change. But as I'm looking at it right now, I see they're going to hike rates in the spring. I think we have about 3 hikes priced in over the next 14 or 15 months. So presumably you get that hike and then you get the really good bounce in precious metals. And at that point, with respect to real rates, it's really difficult to forecast, because if they can only hike once or twice, it's something I'd have to think more about. I'm just focused on the next 12 months. I mean, if inflation and growth continue to come down, that obviously they wouldn't be hiking rates for long. And so eventually, that would be moving to a point where something bullish will happen for precious metals. But it's hard to assess whether it's going to be, there's another crisis and then there's tons of fiscal stimulus again, or, there's actually like a real recession and, rates go to zero again. It's just a hard call to make beyond just the first rate hike. But it's going to be interesting to see if the economy has legs for another couple of years, or if it's only, another 12 or 18 months.
Yeah, next year is going to be important. Every year is important, but we've just been through so much in the last pretty much 2 years now with COVID, and then coming out of COVID and all the central bank policies, and now inflation coming, that going into next year, boy, oh boy, fascinating to see where inflation goes, where the metals go, and where the markets go, because man, oh man, the markets, they tend to just keep on moving higher, but that's long in the tooth in itself. Jordan, thank you, as always, for your time, buddy. Interesting comments. We'll chat again next week. Hope you have a great rest of your week.